And our next presenter is Aidan Mills, President and CEO of Northstar Clean Technologies, symbol ROOF on the TSX Venture. Northstar, well known to this Kinvestor family, is a Canadian waste-to-value technology company focused on sustainable recovery and reprocessing asphalt shingles. One of our fan favorites, that's for sure. Had a big strategic update to his shareholders last week that I'm sure he'll tie on some additional information on here today. Aidan, welcome to the show. Thank you so much.
Good to see you, Aaron. Okay. Well, look, Aaron, thanks as always for the invite. Great to join you guys. My name's Aidan Mills. I'm the CEO of Northstar Clean Technologies. And as Arlen said, we've got a proprietary technology that addresses a massive market, and that massive market is the amount of shingles across North America that are going into landfill. We've got a patented technology. We believe we've got a first mover advantage. And the most important thing is that we have a commercial facility now constructed in Calgary that is ramping up. I'll talk a little bit about that today. And we have a pathway to roll out these facilities all across North America. And I believe that's a pathway to $1 billion. You'll hear a lot of CEOs talk about the valuation or the $1 billion tick for their companies today. But we've got a clear pathway to be able to do that, and I'll share that with you. And one of the things that's really interesting, and actually we're discussing this today specifically, obviously, because what's going on in the hydrocarbon industry. But one of the things that we actually is a manufacturing business with oil exposure as our major economic driver. So given today's all about kind of resources, that's one of the things is if you look at the major driver for Northstar, it is literally oil price, and I'll discuss that a little bit in a minute. So listen, this is the kind of the outline with respect to the market size. So across North America, 16.5 million tons of shingles, go to landfill each year. And from a resource perspective, that's more than 20 million barrels of oil. There's an industry driver to reduce that number, reduce it by 50% by kind of 2035 and reduce it all the way down by 2050. A bit like the oil company kind of carbon neutral statements, but ultimately that is the driver to reduce this figure significantly, and we believe we're one of the leaders in the ability to do that. So as you look at our economics, so what do? So we take asphalt shingles, either that have come off roofs or come from manufacturing waste. We take them through our facility, and out the back end comes asphalt, aggregate, limestone, and fiber. Older tiles, the fiber is organic. Newer tiles, it's fiberglass. And the revenue is split pretty simply. So 35% for tipping fees, so we actually get paid for our feedstock, and 65% of the product revenue. And this is where the kind of the anchor to oil price comes, because of that 65% out the back end, 95% of the value of that comes from the asphalt. So that is the thing that we're focusing on. So if you think about Northstar and you think about what's important for the drivers, literally it's the tipping fee and the oil price. So we are literally a manufacturing midstream hydrocarbon asset. So look, I spent nearly 20 years with BP, time with Goldman, and Meg and Husky on the oil industry side, and so we are literally like a midstream asset. But we're a midstream asset where actually the tipping fee means that we have a negative feedstock cost. So the negative feedstock cost, that contributes significantly to the facility processing cost. And in some jurisdictions, that almost completely covers the cost of manufacturing the facility or the manufacturing in the facility. So what actually happens is, if you look at the products out the back end, that is the remaining economic value, and that's where the pivot to oil actually occurs. So last point is, the liquid asphalt price is fully correlated to oil price. So it's essentially a hydrocarbon derivative, and that's where the pivot comes. And so if you think about, 35% of the front end is the feedstock, that we get paid for. 65% is the back end, and as I say, 95% of that is the asphalt price. So if you look at the overall economics, if we build a facility that just runs day shift, so doesn't run 24/7, we would process about 40,000 tons a year. If we run it 24/7, and that's nothing to do with the facility size, that's only to do with the availability of feedstock. Then we run 80,000 tons, we can run 24/7. And then the respective numbers are, if we run just day shift, 10 million a year, roughly in revenue, 5 million of EBITDA. And then if we can run an 80,000 ton facility 24/7, it doubles the figures. So, kind of 20 million of revenue and over 10 million of EBITDA. So obviously strong economics from running the facility. And the upside, of course, is if there are enough shingles in the region, and we can have an 80,000 ton facility. So I'm not going to go into this in detail, but you can see from the industry partners, we've got strong market validation from feedstock, not only ICO, Eco Recycling, but also the city of Calgary. So in December, we announced that we will collect all of the city of Calgary's waste shingles for the next 5 years and get paid by the city of Calgary a tipping fee for that. For our offtake McAsphalt, of course, part of the Canadian sub of Colas, and then from a shingle manufacturing, Tamco from the US. All of these people have been involved in the R&D, and all of these people are looking at the asphalt that's coming out the back end of the facility. Financial partners, well funded, and then we've just announced in the strategic review a couple of weeks ago, we announced a compelling financing that's happening now. So 10 million US, 8% per annum convertible note, which is 5 years. You can see the conversion price and the key features. But this is really important in terms of the way that it is. It's well geared towards Northstar with sophisticated long-term investors, a 5-year term, dilution minimized because there is no warrant in here. It's a premium for the market conversion. And we have additional benefits for us with an acceleration clause, the ability to buy out at any time after 12 months, change of control capability. And all of this I would describe as a well-negotiated deal with a sophisticated group of investors whereby they want the upside as well as us having, lots of flexibility in the financing instrument. And of course, US $10 million, which is great for the bridge. And when I talk about the bridge, that's the bridge to get us to Empower Calgary, the Calgary facility, fully up and running. So one of the things that's important as we think about this is, look, the first facility, we've moved from a pilot plant to the first manufacturing facility, so the first commercial scale-up. That always throws out bottlenecks and processing bottlenecks, some of which that you would never see in engineering and you never see in the pilot plant. It's only when you run the first full-scale facility do these things pop their heads up. We had 3, so 2 in transfer of material, and 1 in water processing. But the most important thing that people and investors need to think about is the asphalt, which is the highest value product coming out the back end, is of excellent quality. So Tamco have said it looks better than they expected from the first facility that we made. So all of that means that the technology works. Now it's just about moving the material around in the most efficient way. So 2 steps: interim production, step 1, which is the ramp up's happening now. Then in the fall we'll do a facility upgrade, and we will get to the full production figures on the back end of that. But we expect to get to cash flow break even in this interim production step as we come into the upgrade. And then, so the 2026 priorities, I talked about this a couple of weeks ago. It's all about this is why the font is like 4 times the size with respect to Calgary. This year's all about delivering the fully commercialized production through the Empower Calgary facility. And what we'll do with Baltimore and Hamilton, which people know are kind of follow-on facilities, is we'll continue to permit, we'll continue to engineer, and all the lessons that we've learned from the Calgary facility, those get integrated into the engineering that goes on for the next facility. So as we continue to roll these facilities out, we learn as we go. The biggest learning, of course, is to come from the pilot plant to the first commercial plant, and after that, it will be incremental. But all of the stuff that we've learned from the construction of the Calgary facility now get integrated into the next ones, which is the beauty of being able to roll this out again and again and again. We've talked about forecasted growth, so we expect Calgary up and running this year, and then build the build of the next two facilities constructing next year, such that they will be up and running by 2028. And then lastly, kind of like the road to $1 billion, and as I said earlier, if we have an 80,000 ton facility, and again, that's defined by the size of the city, it's not defined by the plant, we would expect to be kicking out an EBITDA of around 10 million per year. So if we think about, a 10x multiple on the waste to value scale, I mean, that waste to value multiple is anywhere from kind of like 6 to 14. So just take 10 as a midpoint. Every single plant we build, in theory, should add $100 million worth of EV to the business. And so what we need to do is build 10. And we have the plans with TAMCO in the US. We have the MOU with them for 4 of the first 4 plants, guaranteed offtake with them, and guaranteed production from us. So that's the MOU. We have Calgary, we've got the potential, retrofit of the pilot plant in Vancouver and Hamilton. So if you look at that, that's immediately 7 plants that we can see. So that's the pathway to $1 billion. Well, and that's my $1 billion pitch.
Good. Again, if you have any questions, please type them into the Q&A box. I got a couple questions here for you while we wait for these to come in. Can you talk a little bit more how asphalt prices are related to the WTI and like a little bit more detail there?
Yeah, I mean, asphalt is no different to oil price than kind of gasoline or diesel or jet fuel. It's just a derivative product. So when the oil price goes up, the derivative price goes up. Now, it depends on the various markets. So people will know when refineries. So as an example, so you heard it a couple of weeks ago. Refineries generally do their shutdowns in the winter because that's when gasoline demand is lowest. It's the same for every refined product. Asphalt's exactly the same. Nobody's paving roads in December in Boston. Nobody's roofing houses in December in Calgary, right? So the demand for asphalt goes up in the summer, and so you'll see a seasonal curve where the price compared to the crude oil price will be a lower ratio in the summer, and a lower ratio in the winter and a higher ratio in the summer because there's actually just product demand within that product. Same with gasoline, same with distillate, diesel. But you heard like a couple of weeks ago with the conflict in Iran, US refiners saying we're going to delay our shutdowns, so we'll keep on producing refined products, so we will not starve the market of refined products. So they've extended their shutdowns, today. So what that will mean, though, is it means that the gasoline price, will, as you know, the gasoline price, when the oil price has gone up, the major impact that you see as a consumer is the gasoline price. Asphalt will be doing exactly the same.
Mm-hmm. And then when you say like direct participation oil price upside with no exposure to crude input cost volatility, it's not only that, is it? It's also the fact that you might actually get the benefit of inflation on your input costs too, as well. Like that's because your tipping fees are only going to go higher, right?
Yeah, and if you look historically, tipping fees have never gone down. So, if you look at the US figures, they're about 5% per year on year, because as you know, no landfills are emptying. Nobody's building new landfills. Or sorry, even if they are, like it can take 20 years to permit a landfill. So that's where if the space is 20 million or 16.5 million tons a year going into landfill, I mean the diversion of that is a phenomenal step to be able to have landfill operators not worry about all of that volume going in there. So that's the real benefit. and landfill prices are just going up. They're not going down.
Yeah, and asphalt is shingles are certainly bulky and heavy, right? We actually did have a question about that. And it came from what is, being heavy and bulky, what is the effect of transportation to your processing costs and what happens to the other materials?
So when we look at our economics, they're always delivered, they're always economics at the site gate. So we have the buyers pick up at the site, and the shingles get delivered to our site. The only slight difference is in Calgary, we're picking up the shingles from the Calgary facilities. Um, but in general, what we want to do is we want to locate close to a landfill because and then have roofers deliver there. So either a roofer or, if you look at, for example, the Calgary facility, so ICO, they have a transportation company that delivers to us, and Eco Recycling have their own fleet of trucks, so they deliver to us too. So the real benefit of that is making sure that, so what you really want to do if you locate in a city is you don't want to have roofers or the intermediate guys that are picking up stuff have to drive very far. So you want to be located in industrial areas close to the landfill. And so that's always our strategy when we look at a city and look at where we're going to locate the facility.
Yeah. Okay. I've heard roadmap to a billion many times in my life, Aidan. Okay. But I guess the concern is financing and dilution. Talk to us how you get to $1 billion without constant dilution in this name.
Look, I mean, I think if you think about, I mean, we have a view that probably when we have, 3 to 4 of these facilities built, that in theory, if we're kicking out, 10 million bucks worth of EBITDA, we will not need to raise again. So halfway along this road to a billion, we should be in a position whereby we actually don't need to raise. The other thing, Arlen, that's really important about it is as well is the debt support that we have for the facilities. So in the US, we announced with kind of a couple of, in the middle of last year, a deal with EDC for the potential for the first plant and 3 follow-on plants. We have a letter of intent for BDC for the next follow-on in Canada. And so once Calgary has demonstrated, and again, back to the focus in 2026, when we can bring people in through this plant and show them that this is a kind of, 5 to 10 million EBITDA plant, depending on how many hours it's running. That's the real benefit because then that demonstrates that we can service the debt appropriately and we can easily leverage 50% of that build with debt, whether through kind of the municipalities or the banks. And if you look at the number on the left-hand side, given what we know about Calgary, we're very comfortable with the 25 million Canadian to build the facility. So the way that I would describe this is 25 million. 3 or 4 plants in this should be self-funding, and the amount of debt that we should be able to leverage into this should be at least 50% per plant.
Okay. Awesome. No small feat to pull 10 million US dollars in this market at a premium. Do you want to talk about, I know you've said global investors. Clearly you can't name their names, but can you shed some light a little bit? Any more light at all, at least?
No.
Okay.
No, but I would say if you look at the structure of the deal, you can see that these people are long-term investors, sophisticated investors who understand that you can't have a US $10 million debenture which just is single-sided towards the investor or single-sided towards the company. So it's a very, very balanced deal. So it's 5 years, it's 8%, very competitive. It's got to convert at 20 cents US or whatever, 27 and a half, Canadian. We have the ability to pick the interest. So if we want to have shares instead of interest payments, we can do that. There's a prepay which is very straightforward. There's a change of control at 110%. So that when people do those kind of deals, that they are long-term investors and they're not doing it to, and of course no warrant, which, of course there's dilution, but actually significantly less than we could have faced if we used a different vehicle because there's no warrant in this one. So again, it speaks to the level of sophistication of the investors, which has been very good.
My opinion is that it's a very friendly deal for both sides.
And
So
very balanced. It's
very
very
balanced. Yeah, it is
balanced.
very balanced, and it shows that these people cutting checks kind of want to see you succeed. Yeah, yeah.
Um,
Hey, we're gonna have
and,
to.
and Yeah, and so for us, people talked about, well, are you going to build a bridge to kind of get to the, get to the end of the year and Calgary at full pelt? And I'm like, yes, but let's not build a bridge out of paper. Let's build a bridge out of absolute stone and concrete. And US $10
Yeah, yeah.
million to me is a stone and concrete, very, very, very solid bridge for this company.
Okay, and that's all the time we have. There's like 15 questions I couldn't get to, so we'll make sure that those get forwarded off to you, and you can answer those investors individually. Okay.
So, well, as always, thanks for the invite.
Thanks so
Great to
much.
see you guys, and yeah,
Yeah.
let's keep on moving this thing.